inspiration that led success soar high. I will achieve, I will fly high. INDI in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Last week, RBI Governor Shaktikanta Das assured the markets that RBI was not behind the curve regarding rate hikes. The announcement came after the US Fed announced a 75 basis point hike. In another decision, the RBI also said that it would not defer the tokenization deadline. By June 30th, all companies must purge stored credit card data. Good morning, my name is Ishan Gera and I welcome you to the Business Standard Banking Show. This week's episode will cover important banking developments of the week. We have an interview lined up with CEO and MD of Axis Bank, Amitabh Chaudhry. Our Banking for You section explains the NPA classification and how it impacts banks. Further, banking expert Tamal explains RBL Bank's performance and tries to decipher the RBI's decision to choose a new CEO for RBL Bank. But first, here's a look at the important developments of the week. After nearly a year of banning Mastercard from issuing new cards and adding customers, RBI has lifted the ban on Mastercard. The decision came as RBI also announced the relaxation of limits for e-mandates from 5,000 to 15,000 rupees. While Mastercard can now compete with Visa and RuPay to add new customers, American Express and Diners Club are still banned. In a 2018 circular, the central bank had asked these companies to store all information locally. When Mastercard, American Express and Diners Club did not comply and defied the norms, RBI imposed a ban. While it was good news for Mastercard, it was not so good news for entities looking to open a full-stack digital-only bank. At an event, Governor Shaktikanta Das hinted that the time is unsuitable for a digital-only bank and existing entities can cover the field with more technology play. There are concerns that such banking entities may put the financial system at risk. The government, in its budget, had allowed the setting up of 75 digital banking units across the country. While RBI's worry of digital entities, the Insurance Regulatory and Development Authority of India, IRDAI, is taking cognizance of rising incidents of insurance fraud in the country. A Business Standard report suggested that IRDAI is mulling using insurance frauds as a parameter to calculate credit scores. Estimates indicate that the industry may be losing 45,000 crore rupees annually to insurance fraud. The move will make getting a loan for errant users more difficult. Interest rates rising or expectations of rate hikes have not dented the appetite for bank credit. Bank credit grew 13.1% year-on-year in the fortnight ending June 3rd, the highest in last 3 years. Last year, credit growth was muted at 5.7%. The normalization of working capital requirements and housing and consumer loan growth have contributed to the rise. But as RBI embarks on an aggressive tightening, will the trend hold? Bank credit rising would be a good news for banks, as their other sources of income are set to contract in the coming year. With yields hardening, banks would not be able to secure the kind of treasury profits they did last year. Axis Bank was no exception to this trend as it performed well in 2021-22. In a conversation with Raghu Mohan, CEO and MD of Axis Bank Amitabh Chaudhry said that even though the bank has been cautious, it has also been nimble in capturing growth opportunities. Let's listen in.
Welcome to the BS Banking Show. Good to have you on our show after a long time. And now, it's been 3 years since you took charge at the helm of the bank. And it's been a period of growth as well. This comes at a time when others were more cautious. How would you sum up your approach to banking over the last 3 years?
So firstly, thanks a lot for inviting me to this show. Really appreciate it. As you said, our growth engine has been accelerating even as we made significant headway during these last 3 years on our legacy issues. We have been cautious, but we have also been nimble to capture opportunities of growth. We have put the legacy issues of asset quality behind us, sharpened our focus on retail with an asset-led strategy in the semi-urban and the rural geographies. We have tapped higher and better rated corporates in the wholesale banking side. We introduced a mid-corporates sectoral focus in the wholesale banking for the first time. We created a new SME template and so on and so forth. We have also built a strong balance sheet with improving return ratios to drive our aspirations. I believe very strongly that now our asset quality is perhaps one of the best in the business with adequate capital position, improvement in return ratios. Our PCR is improved. Our capital asset ratio is improved from 15.8 to 18.54. CET1 improved from 11.27 in financial 19 to 15.24 in financial 92, and our credit cost has reduced from 1.91% in financial 19 to 1.04% in financial 22. And over and above that, more importantly, we are today sitting on a pretty large provision, which also obviously beefs up the balance sheet in case, as the macro is looking a bit tougher, if there were problems, our balance sheet has the strength to tide over any crisis which might come our way. Analysts have been acknowledging our improving liabilities, NIM and return ratios, our strong presence in the payment ecosystem and the credit card space, and improving digital capabilities. We have recorded, frankly, stellar performance in deposits. Our deposits growth was 18% year on year in financial 22. We have seen an uptick in our advances growth also. While we have a very large bouquet of initiatives across the bank, our core leadership is focused on 19 transformation initiatives within the bank at both business and function levels. Two of these initiatives are looking at how Axis Bank can create areas of distinctiveness, something which Axis Bank will be known for. And finally, we just have to become a better execution engine. So there is a lot of focus on just improving the execution capabilities of the bank. We have also made significant investments in digital banking, on cloud, analytics-driven decision-making, and they have helped us deliver a strong performance.
Can you give us a quick overview as the economy as it stands today, given the switchover in the interest rate cycle and the post-Ukraine war?
Well, as you've seen, many G10 central banks, especially the Fed, are likely, they have said it in so many words, to tighten the monetary policy aggressively, using both policy rate hikes and running down balance sheets to tame inflation levels not seen in a generation. And as many in the market expected, Fed FOMC announced a substantial 75 basis points rate hike. They talked about a roadmap also where many more hikes are going to happen in a relatively short period of time. You yesterday saw UK and Switzerland raising rates. You combine this with supply disruptions of energy and re-engineered value chains. Global growth and merchandise trade are expected to slow even further in 2022. And this is much earlier than expected. You're also seeing that a lot of economists now globally have started talking about likelihood of recession increasing manifold in the last couple of months. And India is obviously cannot be devoid of all these problems. India is likely to be affected by global spillovers via commodities, especially energy, trade, and financial channels. A fundamental market tightness for oil, exacerbated by periodic disruptions, and summer travel demand is likely to keep crude prices high in the near term. And the crude prices are high even though China has seen some specific shutdowns around COVID. We believe China's growth revival is again expected to push metal prices, which have actually cooled over the last couple of months. While RBI has retained its financial year 23 GDP growth projection at 7.2%, we do believe that there are downside risks to this, although the activity in the first 2 months has been quite robust. Persistent high headline and core inflation remains a concern. High input costs have become a problem for MSMEs in particular. Again, RBI's forecast has CPI inflation of 6.7% for financial 23, assuming an average oil price of $105 a barrel. Now let's see how this plays out. Our expectation is that the likelihood of the average price for India for oil will be higher than this number. We also believe Central's fiscal deficit will be higher than the 6.4% budgetary estimate. So there are risks in the macro. And given the risks in the macro and the clear desire expressed by the governor to bring down inflation and actually be proactive about it, given that inflation is way higher than expected, we have to be watchful. We do believe that there are enough variables out there which are uncertain. There is a huge amount of unpredictability and volatility. Asset prices, which had been going up forever, are going to see a deflation. Some of the lofty valuations are going to come down. Raising capital will become an issue. Interesting times ahead of us. I would add in the end that all this uncertainty tends to favor countries and institutions which are financially stronger, which are bigger, have a bigger say in the marketplace. And in that sense, I think this could present an opportunity for the larger institutions in India, including in the financial space, to actually gain market share if this macro was to play out or the macro was to remain that uncertain over a reasonable period of time.
a few banks have either decided to switch over the ratio a bit lower or go easy. Now, what's your view, since we are exactly not out of the woods as far as this economy is concerned?
You're absolutely right. We have been working on strategies to grow the retail book share in our total portfolio. The outcomes are obviously in line with our strategy. It's also been, in a way, helped by the fact that as we pivoted our wholesale book to higher quality corporates because of excess liquidity in the system and RBI pushing down rates, some of the corporates were able to borrow money at interest rates which did not make sense for us. So we obviously have stayed away from a lot of the deals out there. So as the rate of growth in the wholesale book slowed down and retail continued to grow well, the share of retail has also gone up. Also, as you fully understand and appreciate that the private capex demand has not picked up. So overall demand from corporates is more for refinancing rather than financing new capex. And as a result, the combination of all this has been that our retail book has grown. Our retail business is one of the larger businesses in the country. If you look at it on a standalone basis, it is granular, it has higher margins and does provide very good risk-adjusted returns. As Delta, the Delta strain played out in the first couple of months last year, post that the customer sentiment and the demand has improved. We also observed that the retail lending is consolidating and we are benefiting from this trend. So we are quite confident of healthy growth in this space. We do believe that private capex will come back. We do believe that wholesale will start growing. We also believe that India will be one of the fastest growing economies in the world. And as private capex and some of the government capex starts flowing through, the balance between retail and wholesale will hopefully be maintained. So we expect retail would not cross more than 60% of our overall portfolio, but it could go a couple of percentage points up and down depending on how Indian economy performs.
Now, coming specifically to the Citibank deal, how does it fit into the Burgundy positioning of Burgundy, the premium offering from you?
So the Citi Wealth Management franchise in India is a perfect fit and will be, we believe, very, very accretive to Axis Bank's Burgundy proposition. Each customer segment in Citibank complements the corresponding segment we have in Axis. Namely, if you look at Citibank, a Citi Gold private client, it corresponds to Burgundy Private. Citi Gold corresponds to Burgundy. Citi Priority is same as Axis Bank Priority. And Salary, which they call Citi Suvidha, is equivalent to Axis Bank Salary. There could be some clients in Citi Gold and Citi Priority who could move to higher proposition at Axis. This will ensure that the existing Citibank customers actually get upgraded in terms of what kind of services and value proposition they could get from Axis. Over the last 5 years, just to give you some data on Burgundy, we have grown organically our Burgundy franchise to rupees 2.6 trillion of AUM, which is a 27% CAGR growth. The Citi deal will add another 1.1 trillion as of this data as of March 22. So collectively, this catapults us to the number 3 player in the wealth management space in the country. And obviously, we believe that if you look at the time it has taken for us to build this Burgundy franchise, which is quite short, and Citi has been in this business for a long period of time, we have a perfect platform to go and gain even more share in this space as we move forward.
How do you see the MDR issue playing out on the UPI credit card linkage?
Yes, so MDR will continue to be a part of any credit card transaction. However, a large segment of merchants will have come into the fold of digital payments with UPI, especially small merchants. Now, these transactions come with zero MDR, and any new solution market expansion will have to factor this in. The MDR will have to be suitably modified for these set of merchants as a cohort. And frankly, the solution has to come, the industry has to look at it as a unit, and we'll have to devise a solution which takes care of these 2 points. And I'm sure that we will arrive at a suitable solution. Apart from this, with a base of over 30 crore UPI customers and the fact that this base can be underwritten, we have conducted test programs on the base and have seen extremely good results, which makes this entire proposition very interesting and a step forward for both credit cards as well as the UPI market. Now, if you look at some of the announcements which have happened to win on the credit card space, on the RuPay side, the MDRs are lower. So in that sense, I think the industry obviously is watching the space very, very closely. We are one of the largest players in the credit card space. There is obviously a clear need for credit cards, especially when you travel abroad and especially when you're doing larger transactions. So I think both can coexist, but yes, this MDR issue has to be sorted out.
Amitabh, it was nice talking to you. Hope to see you soon. Have a good day.
Thank you so much, Raghu. Always a pleasure. Thank you.
Chaudhry further said that bank has left asset quality issues behind and sharpened its focus on retail, among other things. But that begs the question of what asset quality is and what are non-performing assets. In our Banking for You section, our experts explain what NPAs are, their classification, and how they impact banks.
Bad loans dominated the discourse in the last decade as banks' gross non-performing assets zoomed from 2.4% in 2011 to 11.5% of gross advances by March 2018. Since then, there has been a secular decline in the NPA, which has dropped to 5.97% as of March 2022. The decline in bad loans for the last 4 years is mainly due to banks cleaning up their balance sheets after being prodded by the Reserve Bank of India. Let us now see what NPA is and how it impacts banks. A non-performing asset or NPA is a loan or an advance where interest and or installment of principal remains overdue for a period of more than 90 days. Once a loan becomes NPA, banks cannot charge interest on that account. Banks are required to classify non-performing assets into 3 categories based on the period for which the asset has remained non-performing: substandard assets, doubtful assets, and lost assets. A substandard asset is one which has remained NPA for a period less than or equal to 12 months. An asset would be classified as doubtful if it has remained in the substandard category for more than 12 months. A loss asset is one where the loss has been identified by the bank or internal or external auditors or the RBI inspection, but the amount has not been written off. For substandard assets, banks need to make a 15% provision. If the loan is unsecured, banks must make a 25% provision. Provision here means setting capital aside, which in turn impacts the capital adequacy ratio. For doubtful assets, 40% provision is required if the asset remains in that category for 1 to 3 years. Banks are required to make 100% provision if the asset stays in the doubtful category for more than 3 years. Loss assets should be written off, RBI norms say. If loss assets are permitted to remain in the books for any reason, 100% of the outstanding should be provided for. While gross non-performing assets refer to the sum of all the loans that have been defaulted on by the borrowers, net non-performing assets are the amount that results after deducting provision for unpaid debts from gross NPA.
I am the blue of the limitless sky. I am the inspiration that led success soar high. I will achieve, I will fly high. I am the I in SBI.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Not only Axis Bank but other private sector banks have also performed well in the last year. Although RBL posted a loss last year, its net NPA declined, provisioning coverage improved, and capital adequacy was high. The bank's loan book has grown phenomenally in the last decade. Our banking expert Tamal explains why RBL stocks fell post the CEO announcement and the controversy surrounding it. Hi Tamal, thanks for coming on the show again.
Thank you.
Now, this is very interesting what you cover in this week's Bankers Trust. It's very micro to the level of one bank, and then you'll go to a larger question. Now, RBL's stock tanked as soon as the announcement was made, but you mentioned that the performance was not too bad of the bank. So what is wrong with the bank? Why is stock tanking?
So even I really don't know why the stock tanked. But you think one thing is, banking is one industry where it's the banker who runs the bank. It's very important. This is globally who is the CEO, that's important. Now in this case, probably, I'm not very sure. Probably it could happen. The gentleman who has been picked up was was actually overseeing the entire liquidation process of DHFL. So probably market thought that this gentleman has come with a mandate and here RBI will go for liquidation and it's the end of the road. So that's the reason. That could be the reason. Having said that, RBI definitely not a stature case, which I have said. It had its bad time, but it's not a case of fraud like, say, what happened in the Yes Bank case. RBL is a story of unbridled ambition for growth. That's what happened. It was Ratnakar Bank taken over by Bishavi Rahuja, foreign banker and his team, and they turned it around. And then they moved on a path of very high growth. And that had its own problem. It was depending on bulk deposits on the liability sides, and it was also a lot of unsecured loan on the asset side, and that had its problem. And it had been on the RBI radar for the past 2 to 3 years. So we don't know the outsiders, but the regulator kept a very close watch and had been telling the bank what to do and what not to do. RBI had been, in fact, very closely involved with RBL, and RBL was on a correction path. It puts its risk management, underwriting, right kind of thing in place, right kind of technology, withdrawing from bulk deposit, getting into more granular liabilities, so on and so forth. Still, say for instance, credit card business is 1/5 of its business. It's the largest in the industry. So that was happening. And then the drama. Bishavi Rahuja was expecting another term, but he was denied the term. And then RBI put an additional director, and Bishavi Rahuja left he went on leave. All these things happened. But if you look at that March 31st number, on every key ratio, they're not bad at all.
It is very interesting because we're talking about speculation. I'll take you towards a bit of more speculation from here. You weigh in on the candidates also that applied for the CEO position and speculate on why one was chosen over the other. Now, RBI chose the second one instead of the first one. Can you tell us a bit about the process, how it works for our readers and viewers? And second, why go with the second choice in this time around?
That question also I have. I don't have the answer. So typically what happens is this: when there is a CEO position is vacant, the bank board creates institute a search committee, and the search committee is assisted by an external agency, which is a headhunting agency. In this case also that was the case. Search committee typically have the members of the remuneration committee of the bank, and also other board members, probably one outsider in this case also there. And then they prepare a list of 2, 3, 4 candidates, right? And then they give it to, they passed on to Reserve Bank of India. Reserve Bank of India scrutinizes it. But RBI does not get into the qualitative aspect of those people. Like, is number 2 better than number 1 or number 3 better than number 2? It doesn't. It's a sort of tick marking, fit and proper. If number 1 is fit and proper, then it's automatic that number 1 gets it. Now, this is probably a rare, if not rarest of the rare case. I know there are cases where RBI had rejected all of them. So that's a separate story for some reason. But typically, number 1 gets it. And unless this person is unfit and improper, meaning certain investigation is pending, so on and so forth. But in this case, it cannot be applicable. It is not applicable because this number 1 was heading a foreign bank, and that she recently got a 3-year extension. So which means she is not unfit and improper. Then what are the issues? So RBI probably, what would look at? It would look at culture, it would look at compatibility, it would look at also compensation. So one thing would be foreign bankers' compensation would have been much higher than a retired public sector bankers. I am guessing because I have not seen the recommendation of the search committee. So probably RBI felt that no, even though this compensation is in the form of ESOPs, and ESOPs you need to earn, need to perform, others you will not get it. Probably RBI felt that culturally the foreign banker is not the right person to come to this bank, while public sector bank will be fitter. But historically, we have seen that both foreign bankers and public sector bank, there are cases of failure and successes in this kind of scenario. So I'm not qualified. One thing it shows that RBI probably doesn't have the confidence in the board of, on RBL Bank. Otherwise, I mean, why would you not say yes to number one?
Now, what my question stems from is, shouldn't it be the bank's decision? Because we can also decide on the fit and proper guidelines. In the case of public sector banks, also there's a bank board bureau which is deciding who gets to sit on the CEO seat or who gets to sit on the top management. Is that the right system to go ahead with, or should you leave it to the banks?
Say, Banks Board Bureau is particularly for the public sector banks, not only banks, other public sector financial institutions as well. And trust you me, actually, that's a great thing that had happened, because earlier the way public sector bankers were chosen for the CEO's position was very different. Your proximity to certain industrial houses, your promise to make to certain industrial houses, your proximity to the finance ministry, and I'm not getting into all those gory details. So it was extremely opaque, non-transparent system, and Banks Board Bureau came with the transparency came at all. So certainly Banks Board Bureau is a much better choice than what was previously. And if you're talking about the public sector bank board, what is public sector bank board? It's a majority owned by the government. Yeah. So which means whatever does the Bank Board Bureau need to be restructured or approach things in a different way? So that's up to the government to do that.
Now, taking you away from this week's Bankers Trust to another important development that happened, which was the US Fed hiking rates by 75 basis points. RBI governor came out and said, we are not behind the curve. Now, recession fears are very much there. Would you still go with that forecast of the 50 basis point rate hike in the next meeting? Or do you think RBI will get more aggressive now?
Knowing the Reserve Bank of India and how it has been handling the situation, the tightrope walk, it's like a trapeze artist. It's a very fine balancing between growth and fighting inflation. Yes, the rates need to go up. Yes, Reserve Bank of India will continue to raise rates. I don't know where it will end. Is it 6% or even beyond? But I would not put it beyond 50 basis point. I'll be surprised if it's, but the way things unfold is between now and when the MPC meet happens, it's still time is there. But as of now, I will stick my neck out for a 50 basis point hike, not more than that.
Perfect. Thank you. Thanks a lot for your time this week. We hope to talk to you again soon. Thank you.
Thank you.
Tamal says that despite the Fed hiking rates by 75 basis points, he still forecasts a 50 basis point hike. But a lot would depend on what happens between now and then. That's all for this week. We'll be back next Thursday at 11 a.m. with more news and analysis. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.